James, the market's coming back for the summer break. Looking at the UK, how do you see the macro outlook?
Well, in the UK, GDP in Q2, remember, fell minus 20.4%. That was followed by 2.2% contraction in Q1. The Q2 number marked the biggest fall in quarterly GDP on record and the second consecutive decline, so it put the UK into recession. Now, the economy did bounce back at the tail end of Q2. Shops reopened, factories started to ramp up production, and house building kind of returned to sort of near normal levels pre-pandemic. But despite that, the GDP in the monthly basis of June was still 1/6 below it was, say, in February, according to ONS's statistics. So we've got this situation where now, towards the end of Q3, where we've just had the sharpest GDP fall of any of the G7 nations. So we suffered the most. However, we're now braced, so the forecasters say, for a record-breaking economic growth in the third quarter. And so we have this kind of unusual record of having the worst contraction followed by the strongest rebound. And of course, this anticipated recovery is owed to such extensive government stimulation and the Bank of England monetary easing, and also its financial support directly to industries. And it's collectively, these schemes have kept large parts of the UK economy on life support. And at the peak, the furlough scheme was actually paying the salaries of 9.6 million UK workers. So the job retention scheme alone was estimated to cost the taxpayer between 60 and 84 billion pounds until the end of October. And then the two size-based coronavirus business interruption loan schemes, plus the very, very popular bounce back loan scheme and the Bank of England's corporate finance facility, which is targeted at larger institutions. These are the bread and butter of kind of why the economy has been able to do so well in Q3. Collectively, these schemes, I did some calculations just earlier this morning. The government has already extended 70 billion across these loan schemes. And actually, the Bank of England's coronavirus corporate financing facility has already agreed to additional undrawn facilities to UK corporate institutions with investment grade ratings of a further 65 billion, which may or may not be used. Some probably will, but maybe not all of it. So that's at the macro level. And there's also, in addition to that, there's been sector-specific schemes. I'm sure, Richard, you've been a beneficiary too of the Eat Out to Help Out discount scheme. And that's supported 84,000 restaurants across the UK. So there's been 130,000 claims, and that has cost the taxpayer a whopping £522 million up until the end of August. That's according to government's own figures. And so all of this together is crystallising in sort of over the next month. Much of these support measures are scheduled to taper off, and that's where we are. Notably, the big one is the flagship furlough scheme. The UK government is under increased political pressure as well as pressure from specific business sectors to extend the scheme. And there is some precedent for extending it. Actually, if you look a little bit around the world, we could be seen as an outlier, as Australia, Canada, France, Italy, Germany have all announced extensions at least until the end of the year, and for some of those countries into the new year. In the US, where politics is a little bit difficult to navigate in the lead up to the November presidential election, the Treasury Secretary has said to Congress that another stimulus package is needed there. So at least there's confirmation that something more needs to be done. So the UK looks to be an outlier, but having said so far that they plan to unwind as always stated.
And that's going to be particularly a concern in areas such as retail, entertainment and leisure. And obviously then that has a big impact on the real estate side. Where do you see this heading, James?
The Chancellor's decision on whether or not to extend is just another example of having to make a decision between the lesser of evils. On the one hand, the government does want to preserve viable long-term businesses and jobs that are unable to function normally because the nature of their businesses are unable to operate profitably as a result of social distancing requirements, consumer behaviour changes, broader depressed demand and disrupted supply chains. It's It's a combination of those in many cases. On the other hand, the UK economy can't indefinitely remain on government-funded life support. So the government has to make policy which balances, among other things, dissuading viable businesses from restarting and not to provide unintended cover for sort of zombie firms with long-term liquidity problems, irrespective of the pandemic. So there is a balancing act. And what a lot of the trade bodies and business leaders are sort of intimating is that a possible third way, rather than like complete stop or extension as the existing scheme is envisaged, is to maybe specifically target the most vulnerable sectors. And so the furlough scheme could be, instead of nationwide all industries, it could be specific hotspots for sectors such as retail.
Great, thanks very much. It was going to be really interesting to see how this develops, and of course we've then got Brexit coming into this mix later. But thanks very much, James.